We are watching a market moving with relentless momentum, yet the surface indicators of panic are completely frozen. The S&P 500, tracked by the SPY fund, has climbed to 746, while the Nasdaq 100, or QQQ, has broken out past 740. Both are trading at fresh all-time highs. These records stand in contrast to the volatility gauges. The VIX is sitting near 16, and the MOVE index is at 65, indicating that investors are pricing in an extreme level of calm. However, the data shows a concurrent shift in the currency markets. The US dollar index just ended its multi-month slide, flipping to a daily buy signal. Historically, a strengthening dollar acts as a restrictive force on global equity momentum by tightening financial conditions. Managing a portfolio in 2026 requires determining if the structural liquidity engine driving this rally can outrun this newly established dollar ceiling. This chart aggregates M2 money supply from the US, EU, Japan, and China, the foundational layer of the rally. All four economies are currently printing significantly more money than last year. This global M2 expansion provides a structural tailwind, systematically moving capital into risk assets. The current highs are less a product of speculative mania and more a mechanical reaction to this coordinated liquidity dynamic. Because this expansion is structural, it remains the primary driver of the prevailing bull trend. We see this liquidity's impact in the US ISM Manufacturing New Orders Index. Moving decisively through the 50-point threshold indicates expansion. At 56.8, this is the cycle's first clear expansionary reading. This data confirms that the real economy is growing in tandem with central bank liquidity. The combination of manufacturing growth and rising money supply makes it difficult to justify a panic-selling thesis at these levels. A market backed by both structural liquidity and fundamental expansion validates the decision to stay invested. While the fundamentals are supportive, we need to map the mechanical price action of the indices to identify where the support actually sits. This daily chart of the S&P 500 uses a fast 10 and 20-day moving average ribbon to track momentum, anchored by a 200-day moving average. The green ribbon highlights dominant buyer momentum. The long-term uptrend remains intact, with price holding well above the 200-day average. However, the volume profile reveals structural risks that moving averages miss. Heavy horizontal clusters on the right represent historical trading zones, acting as support but sitting far below active price. Thin bars below today's peak represent air pockets, showing minimal historical trading volume. If a macro shock triggers a reversal, there is no structural support to catch falling prices until they hit those dense zones much further down. This makes tight stop-loss orders unreliable. In a low-volume air pocket, price can move too fast for these orders to execute effectively. The trend is fiercely upward, but the foundation immediately below is hollow. Any reversal through that air pocket will likely be violent. The most likely trigger for such a reversal is the US dollar. The DXY index ended its decline and broken decisively back above the 100 level, marking a technical flip from a multi-month slide into a confirmed daily buy signal. A rising dollar tightens global financial conditions, which exerts downward pressure on liquid assets. Foreign assets, emerging markets, and the earnings of U.S. multinationals are the most immediate casualties of this strength. This shift requires an immediate adjustment. Pause the addition of any new dollar-sensitive long positions until the trend clarifies. The dollar breakout creates a mathematical ceiling for risk assets by restricting the global supply of liquidity. Beyond the dollar, other peripheral indicators are beginning to signal a slowdown. WTI crude oil has rolled over to $76, entering a bear reading that suggests cooling global energy demand. This cooling demand coincides with the depletion of the Federal Reserve's reverse repo facility. This facility acted as a systemic shock absorber, buffering the market against quantitative tightening over the last year. With the facility drained to just $251 million, the market is now trading without its primary liquidity safety net. Between cooling energy demand and exhausted liquidity buffers, the market is operating on a high wire without a net. We have a collision between expanding M2 and manufacturing growth on one side and a tightening dollar with zeroed-out liquidity buffers on the other. In light of these conflicting signals, the extreme calm in the VIX and MOVE indices stands out. Because the options markets are pricing in a period of perfection, Put option insurance against an air pocket drop is currently at multi-year lows. The playbook for this setup is to stay long to ride the liquidity wave, but avoid adding to dollar-sensitive assets. Use the low cost of protection to buy downside insurance before the dollar pivot begins to bite.